Welcome to ESG and the City, your go-to podcast for all things ESG and sustainable finance. We're here to keep you informed and inspired as you navigate the evolving world of ESG and financial services, all in under 10 minutes. I'm Arwen, joined by Maitrai.
And today we're discussing the current industry inflection. The foundations are shifting for stewardship from a narrow compliance-driven model to a broader purpose-driven construct that aspires to bridge asset owner expectations, asset manager execution, and real-world outcomes. Yet, as many in the industry are rightly articulating, that bridge is still under construction, and for some, increasingly under strain.
Let's start with Schroders, who've made waves in their feedback on the Stewardship Code last month, raising the question of whether Stewardship Code is still fit for purpose, and whether it genuinely drives better stewardship outcomes. They noted that, despite significant reporting burdens, there is little evidence that being a signatory has led to meaningful improvements in outcomes for clients or beneficiaries.
It's not just about red tape. Many industry stakeholders note that the code has morphed into a disclosure-heavy exercise that doesn't always reflect real-world stewardship. The industry is increasingly questioning whether the code's current design is incentivizing quantity over quality, leading us into tick box territory, rather than genuine, impactful engagement.
It's a fair challenge. Where asset owners are increasingly vocal in demanding clarity on what their capital is actually achieving, there remains a clear disconnect between expectation and delivery.
So, let's talk about this move from quantity to quality and engagement. Historically, many asset managers and asset owners have leaned heavily on the volume of engagements as a proxy for stewardship impact. For example, recent asset owners analysis quoted in Responsible Investor found that its managers had engaged with 1,400 firms around 3,200 times, but only around 17% of those interactions had specific engagement objectives associated.
A recent report by KCL's Global Investor Stewardship Project highlights a growing trend of engagement washing, where firms report high volumes of activity with little evidence of meaningful outcomes. Internal KPIs often focus on more quantitative metrics, such as the number of engagements or meetings held rather than the impact achieved. As Reddington's recent stewardship report observed, a complete reliance on volume-based indicators such as engagement counts, voting rates, and pages of disclosures risks masking whether stewardship activity is genuinely contributing to long-term value creation.
There's also the issue of bespoke versus boilerplate. If engagement asks are not tailored to the company's context, they see right through cookie-cutter ESG asks that don't align with their commercial strategy. Firms like PGIM and Web are calling for quantity over quantity, engagements that are focused, strategic, and tied to financially material outcomes. Importantly, managers must be more open saying what they can realistically influence and what they cannot.
Right, and this is where case studies become particularly important as the primary tool for asset managers to showcase the impact of their stewardship activities. The problem is, the quality of these case studies is wildly inconsistent. Some are polished to the point of being marketing material, others barely scratch the surface. And that's a missed opportunity, because investors, regulators, and stakeholders aren't just looking for glossy success stories. They want insight into the process, what went well, what didn't, and why it mattered.
And the best ones are reflective, not just performative. They acknowledge complexity, partial success, and even failure, which, ironically, often signals a more credible stewardship process than a glowing outcome with no detail. This means focusing on material issues that directly impact the long-term value of the company, rather than just getting caught up in short-term tokenistic actions.
This is where the Stewardship Code plays a crucial role, right? There's a growing need to simplify, align, and integrate stewardship responsibilities across the investment chain. It is clear that the market wants more sophisticated, outcome-driven approach to stewardship, and the focus is now shifting to the materiality of engagements, not just the optics.
Definitely. So investors are moving beyond a purely quantitative approach to stewardship, focusing instead on the quality and outcomes of their engagement. With pressure mounting for more meaningful actions, managers need to be acutely cognizant of the futility of trying to steward across every issue with every company all at once.
So where are we seeing stewardship and engagement heading next?
So I think we'll see a few major trends. Firstly, on one hand, will be more tailored and stratified stewardship. Firms are moving away from blanket approaches with asset class strategy and influence level driving differentiated engagement models. Smaller funds, as highlighted by Pensions for Purpose, face real challenges here, making structure and focus essential. Secondly, we might see more differentiation between active and passive stewardship. Passive managers will need to justify how they're exerting influence without the leverage of capital allocation. And finally, real-time reporting. Annual retrospectives won't cut it anymore. Investors would want to see dynamic insights to assess impact and accountability more effectively.
The ideal state for stewardship is one where engagement is a tool for driving long-term value, not just an ESG deliverable. It's integrated, it's evidence-based, and it's strategic.
Definitely a story for another time, but for now, we'll end this episode with a question. If the current model of stewardship isn't delivering real-world outcomes, why are we still designing around it? And what are you personally prepared to do differently at your firm?
Thanks for listening to ESG and the City. If you found today's episode engaging, be sure to like, share, and hit that subscribe button wherever you get your podcasts. Any questions or suggestions for further podcasts? Connect with us on LinkedIn at Novartis Global or reach out at esg@novartis.global. We'd love to hear from you. Here's Arwen
And Maitrai,
signing off for now.
Sustainably yours, Novartis Global. This podcast is a 2025 production by Novartis Global. Researched, written, and presented by Arwen and Maitrai. Audio production by Thibault Lacombe.